August 19th, 2019, and it's 9:34 a.m. in London, and it's time to take a look at the markets as we usually do at this time of the day. Let's begin with the euro here, which is slowly trading lower here, and it's pretty much at the midpoint or the median line of this massive pitchfork that has been guiding price lower since pretty much June of 2018. Now this pitchfork is quite interesting. We talked about it a few days ago, and the market was in the proximity of the green line there, and the idea was that if we can move lower from these levels, it would make sense to be bearish, because overall the market is bearish. Pretty much reached that midpoint now, and or median line, that's what it's called. Now, just because we're at the median line doesn't mean that it's gonna jump, because we are dealing with a downtrend. So even though sort of the green line here, which is right now somewhere around 109.51, might act as support, but also this level here, the median line, might act as like some support like here. Doesn't mean that it's time to go long, at least I don't think so. So I'm gonna continue to be bearish, and as for where people might look to sell, again, probably that green line is probably a good little level to work with. Like today, that level is pretty much at 12.35, and as long as your bill is high here, which is 12.94, we should be bearish. If I just get rid of everything here, you can see it's quite straightforward. This is sort of the short-term trend defining level. If we go up to the high, people are probably gonna sell and then go down. Now, if you did short here last week, then there's nothing wrong booking the whole position or booking half of the position. You would book half if you think the market's gonna continue to trade lower. You need to remember this though, it's 2 more weeks until August is over, and then you have another week of September. And this is sort of the last critical time where people have time to take time off. And then after that, you know, it's kids back to school and things like that, and people come back to the office. And probably from that point onwards, maybe the second week of September, we might start to see more and more activity that could potentially cause some decent trends. As well, in September, we have the Fed rate meeting on the 18th, and we also have the ECB rate meeting coming up in September, which could all trigger some significant moves, especially in the euro area with the ECB. As it's anticipated, they might cut interest rates to negative 60 basis points. This is the pound versus the USD, and this is your 6-hour chart. And as you might remember last week, I bumped up the sell zone to make it start from 21.37, 21.50. So we reached these levels today, and we could potentially go down a bit, and we can get rid of these fib lines now because they don't really help us too much. You can get rid of this and this as well. So the general idea is here that we might go a little bit lower. Now again, because it's a bit of a quiet period in the market right now, maybe we'll go down to something like 121. That will be rather reasonable. And then maybe probably as the US session is about to open, so in about 3 to 4 hours from now, we can probably have a bit of a test again of that high. Now looking beyond the near term, as long as we trade below this level, we're dealing with a downtrend, and we could potentially reach this target here, which is the pattern target that we looked at already here since a few months. You might remember when we were trading down here, I said this could be a failed head and shoulders, and I also put an article about that, if I remember correctly, on investingcube.com. So for now, no change to the outlook, remains bearish, but don't get all excited. It might be it just goes down to 121 and then maybe goes back up to the highs again. Because as I said in the past, we're just above major support, which is the 2016 low. So we're just above this level. And if we do have a no deal Brexit, I think we'll trade lower. And the next major support level is at 105. But here, just in the short term, you know, if you're a long-term trader, you want to get involved, where would you rather sell? Probably around 124, maybe up to 126 or so. So this area here you would like to sell. Stop loss above here, and then in essence just allow the market to do, you know, something like this. Let it go up and then down. That's it. Dollar versus the Japanese yen. So here, the market is now trying to trade up towards that sell zone. So we talked about the sell zone 106.45. We're at that level again. The market is trying to trade upwards. Uh, German DAX is up a bit. French stock market as well is up a bit. And it looks like we can probably go up a bit on increased optimism. Beyond the near term, though, we're still dealing with a downtrend. It's perfectly fine to short sell here. It's a bit like the GBP USD, very, very close to price action. In the longer run, though, I still think, we're probably going to trade lower. As long as you're below 109.35, I think it's a bearish market. As well, I think we're not out of the woods. If you look at some of the analysis that the economists are publishing, like clever people, not all of them. It's not saying they're not clever. It's just that it's all about which models they use, and they're all sort of not all, but some that have been sort of right in the cycle are projecting further weakness. Let's move along here. Crude oil prices, they're in the middle. So no real change here. I have, however, made some changes to the analysis bit. You might remember this high was up here at the July 11th high. Now it's at the July 31st high at 58.59. So we're narrowing down that range now, which is good. So maybe next time we trade above this, we'll have a breakout. Again, it's just about waiting, and that's why I've been insisting. I've been insisting that we should wait here for quite some time. And we would not have won anything or lost anything. I mean, we haven't done nothing of that because we haven't really touched it, right? Of course, maybe you could have bought at the lows, sell at the highs. And if you're good at that, then yeah, by all means do it. But I know myself, I'm very bad at trading these ranges. I don't have the patience for them, so I don't really touch them. I just wait. Now, this is the price of gold. Now, if you look at it from a big picture perspective, this is your weekly chart. With no doubt, this is a bullish trend. We talked about the break here already in 2018, but never had that break. Instead, we had that decline, which we managed rather well. And then we've been pretty much bullish from these levels here. And then I said that on a break to 13.79, we're going to go upwards. And I still think we're going to go upwards. I think we're going to be at 1,600, maybe even higher, because this is a massive inverse head and shoulders. Get yourself your left shoulder, double right, and then I guess you can argue this is your left. And then if that's not enough, you have this section here, which is an ascending triangle, which has that first target of 1,600. Now this is your weekly chart, and now you can see the market. I don't really use RSI for these purposes, but just to show you today, it's rather overbought. And even in the daily, I think it's rather overbought. So the way I primarily use to know if something is overbought or not is using the risk-reward ratio tool. Like if I buy something now and my potential profit is lower than my potential loss, then that's overbought according to the risk-reward ratio. So we don't have to be very sort of experienced to sort of see that we're at these highs, and this is probably the most important low down here at 13.99. We can easily have a correction, and that's what I'm looking for, really. Now that will be my trend defining level, and then you have these fibs that stretch and give you all these three different levels. So my preference would be to buy somewhere down here around 1460, 1457. That's the 50 level. So here or here would be my preference. Now sometimes when the trend is really bullish like it is right now, you don't get that second opportunity to get long. So if you're really bullish, then maybe just getting involved somewhere down here with stops just below at 1476. However, that's not my preference. I'd rather forego and miss this opportunity, waiting for that pullback than buying up here. In fact, since we spoke about this when we started to reach these levels, we haven't moved much higher. So I'm waiting for, actually no, I'll take that back. We did actually move, I think from here already. I started to talk about a pullback that never happened. Market moved up with 4%. But since August 7th, not much has happened. So again, there's two options here, or there's several options, of course. But if you want to go with the trend, if you want to be a trend follower, which seems to be the most prudent thing to do given the way U.S. is cutting interest rates, the ECB is cutting interest rates, Australia's cutting interest rates, New Zealand's cutting interest rates, everybody's cutting interest rates. When interest rates go lower, it tends to imply higher gold prices. Not only that, the reason why they're cutting is because the economy is slowing down, right? So there's reason to be bullish on gold. So I prefer being bullish. It's just about working with the right level. But if you're really, really bearish, you think stock markets will collapse in the next few days, then you're looking at buying here. If you're more like me, you think stock market's going to actually sideways probably for like 2-3 weeks, and you think the dollar can strengthen a bit, and you want to have that good risk-reward ratio, then it's done here. Let's talk a bit about stock markets then. So this is the German DAX. So the German DAX was very short-term bearish here, but as I wrote in an article, I said until we take out the August 8th high, and I also mentioned this in the videos, of course, until we take out this level, we're still dealing with a downtrend on the daily chart. It's like no secret. If I just get rid of everything here, you can clearly see how we need to take out that high for the market to turn really bullish. And what happens when we approach a high like that is that people try to sell. So for now, it looks like that entry was really good if you traded on the back of that. And we're looking for that to, if we revisit, probably people are going to sell again. Maybe we go down something at 11,436, and then we'll see what happens. If you look at the S&P 500, the S&P 500 is trading sideways. That's pretty much what it's doing. I have, however, changed things up here a bit. The trend defining level, it was here, it's now down here. And I think if we revisit these levels down here at 2860, I think people are going to be looking to buy. If you happen to be really, really bearish, then you're looking to sell probably from 2969, which stops just above. At least that's what I would do if I was really bearish and really interested to short sell the markets. The alternative is that you wait for a break to the low here, and then you could probably have a steep pullback. It wouldn't be unrealistic for the market. Maybe if we take out these levels, we go down to something like 2563. And I think that's pretty much it. I think we covered all the main markets. Let's see if you guys have any questions. So we have Abu Bakar here. Good morning to you, sir. And we have Anas Dora as well. Good morning. And Marvin. Hope you're doing good. If you guys have any questions, just put them in the chat box. Markets are, of course, just, a little bit quiet. And this is actually a good opportunity to research a bit. While I've been using trend following systems from 2014, the system has always evolved a bit. Like in 2014, I remember having wider stop losses. I was playing around on pyramiding. Pyramiding is when you buy more into a position. And now I'm working primarily with classical chart patterns. But this hasn't been the year. The last 12 months I haven't been like very good for chart patterns in general. So when it's a bit quiet, it's a very good time to read up. And I also actually found this one. You guys know Ray Dalio? So Ray Dalio, I think he's one of the world's American billionaire and hedge fund manager. So he wrote a book called Work Principles, or Principles. I have that at home. But that's not, and it's quite cool, it's alright. I mean, it's good. It's good. However, there's something far more interesting that he has written, which is this one. Which is a book called Big Debt Crisis. So what they've done here, or what he has done, is he looked into, I think it's 48 different episodes in the last 100 years or so, where, cause I don't read the first few pages, by the way, where he looks at how the economy works, his point of view, how interest rate influence the economy, and how debt really influences the economy. And I started reading this weekend, and he talks about the um, talks about the cycles in general, and talks about the different sections uh, of these bubbles. Because the way he looks at it, and I don't disagree. I don't disagree. The way he looks at it, because you see, throughout history, things things come and go in cycles. Like there's another book which I read, which is called this one, which I showed to you guys many times. It's called Devil Take the Hindmost. It was published already a few years ago. But this one just explains sort of notable sort of booms and crashes. Like it starts out at the 1960s, right? However, it's more sort of explanation, like the run up and then the crash. It doesn't necessarily go into details in a way that you can necessarily apply it to financial investing and trading. But this one does so much more. What we can learn from this one, though, is just that the markets, at least from the 1960s, 1690s, and as well, they talk about a crisis in the Roman Empire. Um, how that, if you just read what happened there throughout here, you'll see that it's not like a big difference compared what we had in our big recession in 2008 to 2009, right? And 2010. It's not a huge difference, and what we definitely know from here is that you have massive crisis once in a while, and trading with a trend following system on the way up and on the way down is an absolutely would have been made a lot of sense. It would have worked. But what this one does is that it examines things much more in detail, and it's something I started to read. And the idea here that he has is that he goes through all of these different examples, right? And the idea is for him is that because he experienced or read up about these different examples, him and his team, the idea is that they will have a rough idea of what's going to happen in the future. So what they have done, of course, is that they have taken all these variables, and then they done like mathematical models that tells them do this, do that, because he wants to sort of avoid, it's not that he doesn't want to avoid human interaction, but he wants the computer to help him, because humans can many times be flawed in the way they look at data and so on. Now this is obviously, they're not going to share their strategy, which literally made him a billionaire, but it does help quite a lot to understand the economy and get you guys better prepared for maybe what may happen in the future, and what's already happened right now. So check it out. It's free, and you can find it via this PDF, which is down here. You can get it via Kindle as well. That's what I'm contemplating, because I'm gonna take some time off. Let me see if I can send you the right book, right link. I'm taking time off for about a week or so in early September. So I'm see if I can read it up there if I don't read it over the weekend. There we go. There's the link for that. It's not technical analysis. It's not going to help you with that. It's going to help you with the bigger picture, understanding the big trends, which you then can use for your technical analysis. Goldie is tell us about Aussie dollar, why it's stuck in the same range since days. So I think the reason why Aussie dollar is stuck there is because the euro dollar is stuck. The euro dollar, which is the biggest pair, hasn't gone anywhere. It's like, you know, the FANGs, like Google, Facebook, Netflix, I think it is, and something else. All these big stocks that are sort of primary drivers of the stock markets. Imagine that they don't trade nowhere. That's really what's happening. The euro dollar is not going anywhere. And that's sort of keeping everything sort of moving really slowly. And as well, the Aussie dollar, from a risk-reward ratio perspective, is slightly oversold. because you can see if I get rid of everything, you can see how we're dealing with a downtrend. So we're definitely in a downtrend, but we're in oversold conditions according to the RSI. But again, it's more about the risk-reward ratio. If you sell here, the next major high is up here. So you could short with the stop loss just about here at 68.30. If you do that, so if you short today, stop loss just goes above. Yes, if we plummet lower, you know, you make good, decent risk-reward ratio. But people that are looking for a better risk-reward ratio, so the people that want to short somewhere up here, they want to probably short at much higher levels. So if they short now, stop loss, say they put it up here, then the market would need to decline with about 300 pip to make just 300 pip. So I think what they're waiting for is a bit of a correction, maybe up to 69.29, something like that. And then if we just revisit the low, you get you 1.16. But if we really go lower, you made some much bigger risk-reward ratios. I think that's the number one reason here. But beyond the near term here, I think they're definitely going to cut interest rates more. I think they definitely are. Westpac, which is one of the biggest bank in that part of the world, in Australia and New Zealand, they think they're going to cut with 50 basis points by February 2020. And then at the same time, I know we know that the Federal Reserve is also going to cut interest rates. And for the upcoming rate meeting in September 18th, the likelihood that we stay that they don't cut is at 0%. The likelihood that they cut with 50 basis points is 7.3, and then you have a 92% likelihood to just cut with 25 basis points to 175, and so the interest rate lands between 175 and 200 basis points. We'll see what happens. You know, the Federal Reserve is not as dovish as the markets are, so that could be something. But even today, the interest rate is here, right? The 200 and the 225, and if I don't forget, the cash rate in Australia should be at 1%. Yeah, so 1% right now. They didn't cut in August, but it's anticipated they might cut at least once or twice again. So again, you have that interest rate differential, which is clearly favoring the US dollar. And then in the case of Australia, you have a situation where they're closely linked to China. And Chinese industrial production was not very good. And I don't think it's going to improve imminently either. Okay, I think we're going to wrap things up. Guys, if you have any questions, feel free to reach out to me. As you know, we are available on Telegram. So I'll send you the link to Telegram. As well, if you want me to add you, I have a WhatsApp channel as well. Well, that's Investing Cube's Telegram. So that Telegram sends you all of the articles we produce here at Investing Cube. And then you have this WhatsApp channel. If you just reply to that message, save my phone on your mobile, then I will be able to send you this daily video, and once in a while I'll send some audio clips and other stuff as well. Finally, don't forget to like that video. I'll see you guys tomorrow, guys. Video here, and once in a while I'll send some audio clips and other stuff as well. Like button. See you tomorrow. Finally, don't forget to like that video. I'll see you guys tomorrow, guys. Video here, and once in a while I'll send some audio clips and other stuff as well. Like button. See you tomorrow. Finally, don't forget to like that video. I'll see you guys